Hello, fellow red dot investors. In this video, I would like to explain what is options trading and how to make money for it, and this is for beginners. Before we start, a quick disclaimer. Please use some seconds to read this disclaimer. Now let's start. What are options? Before we go into this topic further, let's understand some basic terms first. An option is actually an agreed price. We call this the strike price. And it has an expiration date, which gives the buyer the right but not the obligation to buy in the case of call options or sell in the case of put options. Now there are two types of options that are possible. One type is a call option and the other type is a put option. We'll explain both the call and the put option in the next slides. And it has two contracting parties, a buyer and a seller. And the seller, we always call it him or her the writer of the option. So this makes sense because in an agreement there must be always one buyer and one seller. And the buyer will pay a premium to buy the options. The seller in turn will receive a premium to sell the options. This we can apply to the common analogy of a deal. So in a deal, a buyer always pays something to buy something, and the seller should receive some money for selling something. And now assuming that we are bullish about certain share price, which means that we believe that the share price will move up. So what we can do, one of the possibilities is we can sell a put option. What does this mean? We become a seller of a put option, so therefore we receive a premium, which is a profit from selling or writing the option. The example given here is one contract which equates to 100 shares at $8 strike price with 1 month expiration. So let's look at this. So right now the share price is trading at $10, and we will sell the put option at a strike price of $8, which is this red line here. So we expect the share price to move up and not come below the $8. In selling this option, the sellers are obliged to buy the share at the strike price if the price moves below the strike price until expiration. So there are three scenarios possible until expiration. Scenario one would be the share price actually moves up. So from here, back then, the share price actually moves to, for instance, $12 per share. So the result is the option will expire worthless because it cannot be exercised, and the seller will get to keep the premium, which means that this will be a profit scenario for the seller. In scenario 2, the share price is ranging. What does it mean by ranging? It means that from the time that you sold the put option, the share price is moving within a certain range. So you can see that it's moving within a certain range, and maybe it's trading at about $9. The result is then the option will also expire worthless. The seller gets to keep the premium, and it's still a profit scenario for the seller. Then we come to scenario 3, where the share price moves below the strike price. So you can see here in this scenario, at option expiry, the share price is actually trading at $6, and $6 is below the $8 strike price that we agreed upon. So the result is the option may get exercised by the buyer, and the seller has to buy 100 shares at strike price $8, although the share price may be lower than $8, which means the seller will incur a $2 paper loss per strike price and the current price. So let's view this in another way. So right now the share is trading at $6, but as a seller, I have entered an agreement whereby I'm obliged to buy the share at $8 if the share price moves below $8. So I have to buy the share at $8 as a seller. And if I want to close the share position, I have to sell immediately at $6, which means that I'll incur a $2 loss per share. But we call this a paper loss because right now I have not closed this position. I've owned the shares at $8, but the share is trading at $6, which means on paper I have a $2 loss per share. Now, if that is clear, I will move on to the second possible option, which is in a bullish case, we can actually buy a call option. And what does this mean? As a buyer, I will pay a premium, which means I actually sustain an initial loss from buying the option. Again, we use the example of one contract equates to 100 shares. So I enter into one contract at $12 strike price with a 1-month expiration. So in buying this option, I as a buyer have the right to buy the share at strike price if the price moves above the strike price until expiration. Again, 3 scenarios are possible. The first scenario is whereby the share price moves above the strike price. So in this scenario, you can see quite clearly that at option expiry, the share price is actually trading at $14 per share. And this is above the $12 strike price that we agreed upon. So the result is I as a buyer can exercise the option and buy 100 shares at strike price $12, although the share price may be higher than $12, which means that I have a profit of $2 per share. And this $2 is the difference between the current price and the selling price. So why would I profit $2? So we see this scenario whereby the current price is actually $14, but I as a buyer, I have the right to buy the share at $12. So if I exercise my right, I buy it at $12, I can actually immediately sell in the market for $14, which means that I gain a $2 profit per share. Now we come to scenario 2, whereby the share price is ranging. So again, ranging means the share price is moving around the same price range. Yeah, and the result is the option will expire worthless because I don't get a chance to exercise it as a buyer, and the losses that I'll incur is the premium that I paid upfront for the option. Scenario 3 is whereby the share price moves down, so it can move from $10 all the way to say $6 or $7. In this, the result is that the option will also expire worthless. So the loss that I sustain as a buyer will be then the premium that I paid upfront for the option. So this is the general strategy of what we should do. The left side is the bullish scenario, the right side is the bearish scenario. So we've just explained if we are bullish about the share price, what we can do is to sell a put option. And to do this selling, the win probability is actually 67%. Why is it 67%? Because 2 out of the 3 scenarios that we explained earlier, we actually make a profit out of it. What is the maximum profit? The maximum profit would then be the premium that is received upon selling of the share. The maximum loss would then be the strike price per share. And this is assuming that the share price falls to $0. Why is the maximum price, the maximum loss the strike price per share? Because I could be buying the share at the strike price and it immediately falls to 0. So therefore, I will sustain a loss of the strike price that I bought at per share. And of course, the scenario that we explained earlier, we could also buy a call option, and this one only has a win probability of 33%. Why 33%? Because only when the share price moves up, then this trade will be a winning trade. And there is only one scenario out of 3 scenarios. The other 2 scenarios being the share price is ranging or the share price moves down. Yeah, so it's 1 out of 3 scenarios, so 33%. So the maximum profit in this case would then be the current price minus the strike price. And the maximum loss would then be the premium paid upfront. Okay. So conversely, in a bearish, if you are bearish about the share price, then we could do exactly the opposite thing. So instead of selling a put option, we will then buy a put option. Instead of buying a call option, we will then sell the call option. And adopt the strategy according to one's risk appetite and whether is it bullish or bearish. We can also make money with options regardless of the share price movement. So you can see we can be bullish or we can be bearish, but there's profit to be made in all the scenarios. And options can be a powerful complement for stocks. For example, we can be receiving an income by selling a put option while waiting for the share price to move lower to the target entry price. And now we have come to the end of the video. Thank you for watching. Please subscribe to my channel, like the video, and hit the bell button to be notified of further updates. And invest safe.